Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500 yearly close. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the holiday sale on Into the Cryptoverse Premium at intothecryptoverse.com. You can in fact see that we've brought home the yearly close here. The S&P 500 closed down about 19.44% on the year. And if you were to compare that to prior years, where we had, fairly substantial bear markets, you'll notice that the 2008 bear market was down about 38%. So clearly it wasn't that bad. But then you also can see during the dot-com crash, we had 3 years that were red in a row, 10% down, 13% down, and then finally 23% down. So this year has been somewhere more or less a mix of say, what happened back in 08, not nearly as bad, but also a little bit worse than some of these initial years in the dot-com crash. Now, what I'd like to do is then switch this back over to the trend lines that we've been following. And it's interesting, right? Because despite everything, despite all the discussions about, fake out rallies and all this other stuff, the base case of just simply assuming that the S&P 500 will get rejected by the trend line continues to pay off, right? Our thesis that cash remains king continues to pay off, right? And just simply assuming that the bear market will continue, especially amidst a Fed tightening cycle during a period of high inflation. History shows us that this will lead us into a bear market, and as it has, right? I mean, this year has just been a bear market year, as we generally suspected that it would be. Now, it might make you then, of course, question, well, what's in store for 2023? One thing to remember is that these bear markets can actually last quite a long period of time. And bear markets that include recessions tend to last over a year. Okay, so if they don't include a recession, I think typically they're less than a year. But when they include a recession, they can go on for well more than a year. And if you were to compare this bear market to all prior bear markets, this is what it currently looks like. So this blue line in here is the 2022 bear market. If we hide all of them and then compare this bear market to, say, the financial crisis, this is what it looks like. Now, it was around this time, actually, that the financial crisis experienced a major drop where we essentially ripped the Band-Aid off. And I know that might seem quite scary. On the contrary, this would actually probably be the less painful solution if we were to just rip the Band-Aid off. If you compare what came after the financial crisis and after we ripped the Band-Aid off, and you take this out towards the next peak, you can see, what ultimately came after it. Sometimes ripping the Band-Aid off isn't necessarily the worst thing. But what you'll also notice is if you compare this to, say, the dot-com crash, you'll see that the bear market there didn't really have a period where the Band-Aid just got ripped off. Instead, it was just a slow, systematic bleed. So we have to be prepared for this, right? We have to be prepared for a longer bear market than one of the ones we've seen, right, in a long time. I mean, if you look at the S&P 500 for the last decade, it's been mostly just up, right? Look at this. Since really February of 2009, it's mostly been up. This is really the first time we've had a bear market that's kind of lasted. And you'd have to really go back to the financial crisis or 2008 to find a period that is at least somewhat similar in terms of the duration of the drawdown and the degree to the drawdown. And I mean, so far, this one still does not compare to the duration or to the degree or the duration of these two prior bear markets, both of which saw the S&P drop 50%. Now, the S&P doesn't necessarily have to drop 50 or 60%, but one of the things to consider here is that it could certainly last, quite a bit longer than it already has. And you might say, well, why are we so confident about a recession? Well, first of all, we shouldn't be overly confident about anything. Anything can always happen. But I think one of the reasons why the base case continues to be that we will experience a recession is because, we can see things like the yield curve have inverted. We know that when Treasury yield spreads, like on the 3-month and the 10-year or the 2-year and the 10-year, when we see them invert like this, and especially for this duration, we usually come out of it into a recession. And it's usually during that recession that the S&P 500 bottoms, with the exception of, say, the dot-com crash where the bottom came after the recession. But normally it actually comes during the recession. And the other thing to consider too is that normally the S&P 500 bottoms once the unemployment rate starts to go up, right? But it also bottoms before it peaks. The unemployment rate has not really started to go up yet. So I think one of the things we're probably going to be looking to see in 2023, as painful as it might be, is the unemployment rate going up and ushering in some type of a recession due to the Fed continuing to raise interest rates. Unfortunately, they've felt compelled to, and I think they made the right decision because they need to get inflation back under control. If they were not to act aggressively, as they have, we could run the risk of repeating something like we saw in the 60s, in the 70s and the early 80s, where you essentially saw, a decade where the market was more or less flat and we put in slightly higher highs and slightly lower lows. I would prefer not to go into a period, something like this, where we just get into an inflationary decade. I would prefer not to see something like that. So while it is painful to deal with high inflation, and it's painful for a lot of people to deal with rising interest rates when the economy is slowing down, I do ultimately think that it will help bring inflation back down. A recession will help bring inflation back down. It'll help us find our bottom in risk assets, and then I think that will provide generational opportunities for quite a lot of people. So, in 2023, I'm of the general opinion that the S&P 500 will eventually put in a new low, and then hopefully we can sort of build out a base that we can climb out of in say like the 2024, 2025 timeframe. But again, so far this year, as you can see, quite frankly, a pretty bad year for the S&P 500. Not that it's that surprising. Cash is king this year. We know that. My general expectation is that cash will remain king for at least part of 2023, but likely not all of 2023. Hopefully this video series on equities and the S&P 500 has been useful. Make sure you subscribe. If you haven't subscribed, give the video a thumbs up. And remember to check out the holiday sale on Into the Cryptoverse Premium at intothecryptoverse.com. Thank you guys for tuning in. Subscribe, and I'll see you next time. Bye.